We are kicking off today's deep dive with the story dominating tech desks this Friday morning. Meta Platforms is surging, and the headline explanation about a new artificial intelligence model release is actually masking what is really driving this trade. The Nasdaq 100 is up 1.66% this morning, and Meta is riding that wave hard. But experienced traders know that a single model launch rarely moves a megacap stock of this size in isolation. The real story is a confluence of structural forces in advertising, artificial intelligence monetization, and sector rotation that have been quietly building beneath the surface for weeks. Here is the factual setup on the tape right now. The Nasdaq 100 is up 1.66%, dramatically outpacing the S&P 500, which is up only 0.85%, and the Dow, which is barely managing gains in positive territory. That spread between the Nasdaq 100 and the Dow Jones is not noise. It is a deliberate rotation signal. Growth and technology are being bid aggressively, while value and defensive names sit flat. The 10-year Treasury yield has dropped to 4.54%, down 0.66% on the session, and the 5-year yield has fallen, down 0.91%. Falling yields are the mechanical fuel behind this growth rotation. The macro transmission mechanism here is textbook but powerful. When Treasury yields fall meaningfully in a single session, the discount rate applied to long-duration cash flows, the kind that dominate Meta's artificial intelligence-driven revenue projections years into the future, compresses substantially. That mechanically expands the present value of those future earnings streams and justifies a higher multiple on the stock today. This is not speculation. It is how institutional models are remarked in real time. The short end of the curve is also softening, which reduces the opportunity cost of holding high-growth equities over cash equivalents. The beneficiaries here extend well beyond Meta itself. Google and Amazon are deeply exposed to the same digital advertising tailwind narrative. If Meta is being re-rated on artificial intelligence monetization potential within its ad stack, the street will apply similar logic to Alphabet's search and YouTube business and Amazon's rapidly growing ad segment. NVDA benefits as the hardware backbone of Meta's artificial intelligence infrastructure build-out, since every dollar Meta commits to large language model training flows directly into NVIDIA's data center order book. On the risk side, smaller ad platforms like Pinterest and Snap face a more ambiguous read. Meta gaining artificial intelligence-driven pricing power could pressure their competitive positioning and make advertiser budget allocation harder for them. Traders need to monitor 3 specific things heading into the close and next week. First, the Nasdaq 100 has support near 720 and resistance above 730. A clean break and hold above 730 would confirm this rotation has genuine institutional conviction behind it rather than just a short squeeze. Second, the S&P 500 needs to clear 755 to signal a broader market breakout beyond today's tech-led move. Third, and most critically, the 10-year yield at 4.54% is at an important juncture. If it continues drifting toward 4.4%, growth tech has significant additional runway. The VIX is at 15.91 today. A sustained move below 15.5 would remove the remaining near-term hedging pressure and allow momentum to extend into next week's trading sessions. Here is the single most important takeaway from everything we have analyzed today. Meta surge is not really about one artificial intelligence model announcement. It is a macro trade dressed up in a company-specific narrative. Falling yields, a widening gap between Nasdaq and Dow performance, and the repricing of long-duration growth cash flows are the actual engines. Smart money is using the artificial intelligence headline as a permission slip to add risk in the space they already wanted to own. Watch the 10-year yield at 4.54%, and the Nasdaq 100 as your real-time indicators of whether this momentum is sustainable. That is the single story driving markets this Friday, and the full breakdown is now up for you. If this kind of institutional-level analysis is what you want every single trading day, hit subscribe right now and turn on the notification bell so you never miss a breakdown. We go deeper than the headlines on every story that moves markets.